Welcome to The Explainer. Today, we're putting on our expert analyst hats to evaluate a true financial heavyweight, CME Group. We're not just looking at standard metrics, though. We're putting this company through an absolute gauntlet. We're talking the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham right alongside some rigorous modern quantitative models to see exactly how this stock holds up.
Okay, let's look at the agenda for today's test. We'll start with a company snapshot, apply the Warren Buffett lens, then the Peter Lynch lens, move to the Benjamin Graham lens, dive into DCF and alternative models, and wrap up with a synthesis and final verdict. Let's get right into it.
Section 1, CME Group Company Snapshot, the fundamentals of a derivatives giant. So before we apply our guru lenses, we need a baseline. Right now, CME Group is trading right around $287.65. If you aren't familiar, CME operates as a massive global exchange. Think of it like the ultimate toll booth of global finance. It brings buyers and sellers together to trade futures and options contracts across interest rates, equity indices, energy, and agricultural commodities. Let's look at some quick stats. At a massive $110.7 billion market cap, a few things really stand out. First, it has an incredibly low beta of 0.50. That means it's historically half as volatile as the broader market. Add in a healthy dividend yield nearing 4%, and it looks pretty safe. But with a trailing price-to-earnings ratio of 28.62, you're clearly paying a hefty premium for that low-volatility, flawless balance sheet.
Section 2, the Warren Buffett lens, moats, management, and margin of safety. Now, on paper, this company is exactly what the Oracle of Omaha looks for. CME has an insurmountable economic moat, absolutely dominating the U.S. interest rate derivatives market. And their earnings consistency, it's literally stunning. We're talking a 62% net margin compared to a peer average of just 24%. Debt is highly manageable, and most importantly, their owner earnings, which is Buffett's term for the actual cash left over for shareholders, show projected free cash flow rising from $3.6 billion to over $6.4 billion in the next decade. But you knew there was a catch, right? The bull case rests heavily on those incredible 72.8% adjusted operating margins. The bear case, however, is where a strict Buffett analysis hits a brick wall. Forecasted annual earnings growth is a super modest 3.3 to 5.4%. Because you're paying a premium multiple for such low growth, a strict value investor is going to really struggle to find a sufficient margin of safety at $287. Section 3. The Peter Lynch lens. Growth at a reasonable price. Okay, since Buffett might hesitate on that price tag, let's see how Peter Lynch categorizes things. Based on consensus forecasts of just 3 to 5% annual growth, Lynch would immediately label CME Group as a stalwart or a slow grower. These are those large, established companies that give you great downside protection, but let's be real, they aren't going to double your money overnight. The real issue pops up when we apply Lynch's famous PEG ratio, that's price to earnings divided by growth. With a forward PE of 24.4 and an optimistic growth rate of 5.4%, the PEG ratio sits around 4.5. Now, Lynch famously preferred a PEG ratio of 1.0 or lower, so by his standards, you are overpaying significantly for the actual growth you're getting. Furthermore, check this out. A whopping 94.5% of CME's stock is held by institutions. Lynch hated massive Wall Street ownership. He preferred undiscovered, under-the-radar assets that everyday retail investors could scoop up before the big funds in expensive suits jumped in. At nearly 95% institutional ownership, the secret is definitely out on CME. Section 4. The Benjamin Graham lens. The defensive investor's strict checklist. Running CME through the father of value investing's checklist is kind of a tale of two halves. CME easily passes Graham's defensive checks for adequate size, strong financial condition, earnings stability, and a reliable dividend record. But it completely fails his valuation requirements. Graham was notoriously stingy, demanding moderate price to earnings and price to book multiples. At nearly 29 times earnings and almost 4 times book value, it fails these checks spectacularly. And this becomes painfully obvious when we use Graham's exact intrinsic value formula. He used a multiplier of 22.5, which represents his strict maximums of a PE of 15 and a price-to-book of 1.5. Multiplying that by their EPS and derived book value per share gives us an intrinsic value of just $142.66. So for a Graham-style defensive investor, there's absolutely zero margin of safety here. He literally wouldn't touch it at these levels. Section 5. DCF and alternative models. The Wall Street quants take over. Moving on from the legends, let's look at the math. Discounted cash flow models actually present a divided picture depending on your assumptions. The Simply Wall Street DCF model sees the stock as overvalued, giving us a fair value of about $245 based on modest forward growth. However, the Henry Fund's base case model is a bit more optimistic on long-term cash flow generation, projecting a fair value of around $301, which suggests a slight upside.
But here is the absolutely crucial takeaway. These DCF models are highly sensitive to their underlying assumptions. Using the Henry Fund's inputs of a 6.76% weighted average cost of capital, which is basically what it costs the company to fund itself, and a 2.5% terminal growth rate, we see massive volatility. Just a 1% increase to the cost of capital drops the implied stock price by a staggering 22%. It just goes to show how little room for error exists when you buy a slow-growth company at a premium.
So, what if we look at comparable peer multiples instead of cash flows? CME trades at a 2026 forward PE of 23.48. This is a slight premium to its primary peer average than companies like ICE, CBOE, and NASDAQ, which sit at around 21.86. Applying that average peer multiple implies a relative fair value of $266, which again suggests the stock might be slightly overvalued right now.
However, let's introduce one final model, the dividend discount model. Because CME has a highly consistent capital return policy, they pay regular quarterly dividends plus an annual variable dividend, this model heavily values those future payouts. Under the DDM framework, the valuation jumps all the way up to roughly $325. This is easily the strongest bull case for income-focused investors. Section 6. Synthesis and Final Verdict. Bringing it all together. We've run the numbers through 6 completely different frameworks, and honestly, there's a clear divide here. Strict value frameworks like Graham's formula and conservative DCFs sit way below the current stock price, basically screaming that it's overvalued. Meanwhile, models that prioritize its dividend safety and dominant market position like the DDM see it as fairly valued or even slightly undervalued. Ultimately, here's the verdict. If you buy CME today, you are buying a world-class, wide-moat business with absolutely flawless margins, but you're paying a steep premium for it. That modest 3 to 5% earnings growth leaves very little room for error. A above-it-style investor is probably waiting for a pullback closer to the $245 DCF level to find that margin of safety. Graham wouldn't touch it anywhere near here, and Lynch would need to see a major acceleration in growth to justify that high PEG ratio. So, armed with this complete gauntlet of financial tests directly from the sources, where do you stand? When a company has a flawless economic moat but a demanding premium price tag, which matters more to your portfolio? The safety of the castle or the price of admission? Are you a buyer, holder, or seller of CME Group at $287? Let me know. Thanks for joining me on this explainer, and I'll catch you on the next one.